Well, anybody in the mortgage industry who needs to assess the true value of mortgage debt and also the homes behind them rely on this data from CoreLogic. The firm's chief economist, Mark Fleming, joins us now. The firm also develops risk models for the housing market. So as I mentioned, the data very important for the mortgage market. Mark, first off, talking about risk, how much riskier is it now in the housing market?
Riskier now than, say, a year ago. I think we're getting to a point where we're not sort of falling off the precipice in the housing market anymore. So not that there's less risk, but the amount of risk is ceasing to increase dramatically anymore.
But as you could well imagine, and no surprise from seeing the data we saw last week from existing home sales, new home sales, some believe we're actually teetering now, edging closer to that precipice.
I think there's certainly a renewed weakness in the housing market. The government stimulus programs are being withdrawn from the marketplace, and now we're seeing the amount of private demand that's out there, and it's looking like it's not very much. So we expect, prices as the barometer of the health of the market to probably recede moderately again in the latter part of this year, unfortunately, and we'll have a little bit more price declines before, hopefully in 2011, we really see a growth take hold consistently.
Well, but enough, though, the decline's enough to cause trouble, let's say, for Fannie and Freddie again?
Certainly there'll be further losses for anyone, including Fannie and Freddie, holding large portfolios of mortgage assets. That's to be sure, but nothing of the kind we've seen over the last few years.
And why not? Why not?
Well, a lot of it is, what's done is done, and a lot of the worst of it has already happened. There's just nothing that we see that says, we're going to have price declines like we saw in 2008 and early 2009 again because of this weakening in the housing market. So it's all, time is one of the best cures at this point for the marketplace.
Okay, but, a lot of people have said, look, the government, though, has been really part of this recovery, or a large part of this recovery. You've got the home buyers tax credit basically going extinct. Where is this new demand going to come from? I mean, if it's not going to come from the government, then where?
That's a very good question. I think there's not going to be a lot of demand, period. We have had historically low interest rates for a couple of years now, and they remain low, in fact, in part because of some of the issues in Europe, and that's creating affordability. But other than that, I think people are, there will be some muted private demand, but just not a lot. The housing market can make its way through on some limited demand like that. It's just not going to grow with any significant robustness. And after all, I think we don't want to see it grow like it did the last go-round, because that clearly was unsustainable. Right,
that could create another bubble. And we hear that a lot, Mark, is that, the housing market, don't expect fireworks. You just might see sort of a slow trend upwards. So just before we leave you, though, Mark, what kind of data are you looking for this week that's going to tell you something about the housing recovery? Is it going to be the jobs data or what?
Yeah, I think at this point, clearly what will drive housing recovery is now the economic health of this country. And so the jobs data, the income data that came out today, in the long term, house prices rise in lockstep with income. So if the economy's not healthy and incomes aren't growing, then house prices are unlikely to grow either. So, we're looking to see how the economy recovers over the coming months, and that we, create jobs and begin to spur some income growth that will then spur some house price growth.
Okay. All right, Mark, good to talk with you. Good to get your perspective on the housing market. Mark Fleming of CoreLogic.